For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Jake Floyd and Jeff Shade.
Good morning and welcome to Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name is Jeff Shade, and as always, you know me. I'm just here to ask the questions for you, but the words of wisdom and solid advice, they come from Randy and Jake Floyd of Floyd Financial Group. Randy is off this week, so Jake, how you doing this fine Saturday morning?
I'm doing great, Jeff. Thanks for asking.
Certainly welcome, my friend. Hope everybody else is doing well today, too. Jake, did you realize that it's May already? And in a couple of months, the year's going to be halfway over with. I cannot believe how fast this year has gone by. Does it seem that way to you?
It does, Jeff. And I think, I think Star Wars fans out there, we need to say, May the 4th be with you.
That's right.
But for anybody who's lost on that, it's okay. Don't worry about it. But yes, it's amazing that it's already May. It seems like I'm still waiting for winter to happen, because it never really did around here. But
exactly.
Last week, a week ago, we had all the storms and everything. Started to feel a little bit like spring, but
yeah,
it's definitely amazing how time flies.
Yeah, and when you think about it, it seems like that January 1st was just a couple of months ago. We had all these different prognostications about what was going to happen this year. So here we are, we're entering the 5th month of the season. How has this year or season shaped up by comparison with what we thought it was going to be in your estimation?
I think that a lot of people were expecting, especially a lot of people listening to this show, rightfully so, are concerned about the future, but I think that things have gone significantly better than a lot of people would have guessed the first 4 months of this year. However, as we turn the corner and go into May, one of the things we're going to talk about later is, is it time to raise some cash and be a little careful looking into the rest of this year? We'll kind of unpack that here in a minute, but the housing and interest rates situation is, people kind of thought we won the war on interest rates, but interest rates are rearing their ugly heads. And just as everybody's getting excited about Bitcoin is now starting to fall through the floor a little bit. So we'll see. I think it's going to be a wild ride over the next 6 or 7 months for sure. But, we're ready for it. We're ready to take it on.
Yeah, and as you said, inflation has been very, very stubborn. We haven't tamed this yet, and I don't know if we've really made that much significant progress here in the last few months, but inflation is still very sticky. Do you think that these inflationary rates as we're experiencing right now are going to be with us? Is this something that we should just get used to 3% inflation rate, because 2% inflation seems to be something that is not very attainable?
Jeff, I have to be honest. I think the answer to that question is yes. I don't think we're going to be able to do what is necessary to get inflation down to 2%. The only exception to that is if we just simply keep rates this high for longer and longer, eventually we'll just crash the economy into getting interest rates down, as far as inflation rates, 2%. Assuming we don't do that, though, I think we're going to have to settle at 2.5% or 3.5%. And the Fed has been very clear that they're not going to do that, but things change, and it's easy to say that way ahead of time. But now when you're in the moment, are you really going to crash the economy, the world economy, frankly, over 0.5% to 1% inflation?
Right, and you talked earlier about mortgage interest rates. I was checking the other day, and I'm seeing 7.3%, 7.5%, and those are for people with good credit. If you have less than good credit, I would imagine that they would be 8%. And by the same token, too, housing prices are very high as well, too. What does this mean to us in general? How does the housing market affect all of us who may already own a home?
Yeah, we're not seeing a ton of price depreciation in housing. I think we're seeing it cool down a little bit. I do think there's other areas in the United States that are seeing it a lot more than we are. I don't know that it's a huge effect on people that are currently homeowners. I think we are going to see a little bit of stalling in the price of housing, meaning we're not going to see this 20% year over year housing appreciation that we've been seeing for the last 5 or 6 years. But I do think ultimately long-term real estate will continue to go up. As my grandpa used to say, they're not making any more of it.
Right. And, I was looking at some housing prices yesterday, and I'm seeing things that 7-8 years ago till today, those housing prices have completely doubled, which is absolutely amazing. And I think for those people who are thinking of selling their home, maybe buying another home, that's going to contribute to the housing shortage because they're just not going to do that with interest rates as high as they are today. What's your opinion on it?
Yeah, there's a lot of people I think that want to move, but they have a 2.5% mortgage and they don't want to move to a 7.5% mortgage. Their payment would literally go up, 150%.
Oh, yeah.
If they moved. I think there's a lot of people who want to move but will not move because of that. I think if we get interest rates back down to where 30-year mortgages are 4.5 or something, I think you're going to see a lot of action in the housing market. That's when we'll see prices resume their upward climb. The question is that going to take 6 months, 12 months, 18 months, 36 months? And that's kind of anybody's guess at this point. It really is going to depend on who wins this upcoming election and how dedicated the Fed really is to getting to that 2% target.
And talking about the election, do you think that there are a lot of things on hold awaiting the result of this election?
I do think that, Jeff. I think a lot of people listening to this show, Jeff, are less that way than a lot of the rest of the world. I think there's a fair amount of people out there that really don't want either candidate and are just kind of like, hey, let's just see where this ends up before we do much of anything. I think there's a lot of people listening to this show that are probably Trump supporters, and I think that's a good thing. I think it's easy to say at least that of the choices we have, I don't feel like there's a lot of choice. We'll put it that way. But at the same time, I do think that a lot rides on the outcome of the election. I don't think the stock market itself honestly really relies on the outcome of this election, but the economy sure does. And long term, the economy will affect the stock market, but in the short term, I really think after the election, we're going to see the market go up either way.
Yeah, and we've got about 6 more months before we find out about that. We're talking with Jake Floyd of Floyd Financial Group, talking about current events. Let's talk a little bit about earnings season. We're kind of smack dab in the middle of that right now, aren't we?
We are, yeah. Earnings are coming in right and left. By and large, earnings are coming in better than expected, but they're not getting the big pop that you would expect after the last 6 months and the 2 quarters preceding this one, when a company would beat earnings the way these companies by and large have been beating earnings, they would have a huge reward in the stock price. And so we are seeing a sentiment shift that's different from the October through March, sentiment that we had over the last little bit. And so as that shifts, now it's like, hey, we have great earnings and it kind of goes okay, which means the expectations are very high. And that probably leads to a little bit more of a correction here. We'll have to see what happens. But, it's normal for markets to correct. People sometimes have short memories and they're like, well, the market was up. What happened? What happened is it has to come to its senses at some point. Corrections are healthy. And corrections are what's needed in order for the market to take the next leg up.
Yeah, and we were talking off the air about some of these companies out there, and one of the big rages that's going on right now happens to be the weight loss drug Ozempic, and how many people are using it to lose weight. How has that fared in all of this?
A lot of those drugs obviously are wildly successful. It turns out when you put a little bit of liquid in something, you charge $1,000, $1,100 a month for it,
right.
It's profitable.
Right.
And joking aside, we can count on these companies to continue to be greedy. They're not going to lower prices anytime soon. As we see Medicare and insurance start to pick up these drugs, these companies are likely to keep going. They've had huge moves already in their stocks. Eli Lilly, Novo Nordisk makes Ozempic, the one you mentioned there. These companies are up huge already. They're trading at very high multiples, but it's because we're kind of at the beginning of this, not the end. So I think that's an okay place to be in the medical and pharma industry right now. I think that some of these drugs are being reclassified now as heart drugs, not just for weight loss or not just for diabetes, and that will aid them in the prospects of getting it approved through insurance and Medicare. So yeah, it seems like the sky's the limit at this point. I think we're going to see a time where you're going to have 40-50% of the population on these things.
That is amazing. 40 to 50%. What happened to diet and exercise? When it was hard to do, nobody did it. You take a shot and you can be thin again. Yep. But I don't think that is a long-term thing to do. I think really just a healthy lifestyle and exercise is the way to go. Okay, let's talk about Series I bond rates out here. New Series I bond rates. There's a new rate on those.
Yeah, so back in 2021, a lot of people dove into I-bonds because they were paying like 9.6% because the I-bonds are based on the current rate of inflation. And so the new rates for the next 6 months just came out, and it's going to be 4.28%. And so that's in the next 6 months is the annualized rate will be 4.28. And so people that bought these bonds in the first quarter, second quarter of 2021, they're locked in there for 5 years if they don't want to take a penalty. So 5 years will be 2026. So they got a few years left. Overall, it hasn't been an awful investment because I think it was 9.6 and then it went to 6.1 and then it went to like 3.9 and now it's back up to 4.2. So It's not awful, but, it's certainly not 9.6 anymore.
We're talking with Jake Floyd of Floyd Financial Group. We're talking about current events. We talked about the earnings season here, the weight loss drug. Also, we talked about the housing market, inflation, new series iBond rates, 4.2% that you said, Jake. Overall, how do you feel about how things are going here, and how should consumers react to that? Considering what we've been through here in the past 5 months, where do you think we're heading with the market and the economy this year heading into this election season? And I know that you don't have a crystal ball, but what's your best prognostication?
My best prognostication is that I don't think that the left is going to allow Joe Biden to be the president very long, even if he wins. And I think that we're going to see the rise of Gavin Newsom probably. Again, this is speculation on my part. As that happens, I think the market is going to panic some. Anybody out there that's familiar with Mr. Newsom, he's a piece of work, that's for sure. And so
I like the way you put that.
I won't get too far into that, but let's put it this way. If he gets up there and it looks like he's going to be president, I'm going to panic some. So
Yeah.
I think that as we are getting closer to the election, I think people will panic a little bit ahead of the election from a market perspective and an economic perspective. We might see some slowing of spending. But I do think that regardless of who wins or who ends up as president, I think the market is likely to recover very quickly after the election as people find themselves off sides and underinvested. They're going to be forced to chase this market up. There's been a lot of speculation about these magnificent 7 companies: Microsoft, Amazon, Google, Meta, NVIDIA, those types of companies. A lot of people say they're very expensive. I would actually argue the opposite. I think they're probably as cheap as they have been in a long time relative to the next year's earnings. And so I think this thing really has maybe quite a bit more room to run, especially over the next 2 to 5 years as AI really starts to proliferate. Again, I'm not a huge fan of AI. I think we should probably get rid of it. But that's not going to stop Fortune 500 companies from dumping trillions of dollars into it. It's my goal to make my clients money, and so we're going to ride the wave that's coming, not the one we wish was coming. And I think there's tremendous opportunity for those that are paying attention and have a plan.
Well, Jake, I think based on our conversation today, a lot of folks are maybe listening to you and your thoughts resonate with them. And if that is the case with you, you want to sit down and talk with Jake or Randy there at Floyd Financial Group, we're offering the opportunity for you to do just that with no cost and no obligation whatsoever. It is just a casual conversation. It's not going to cost you a dime to talk about your retirement journey and how this market and the economy affects that journey. To get your no cost, no obligation plan, call 417-889-7233. It's 417-889-7233. Now, I realize it is Saturday today. It's not a weekday. It's not a work day, but you can call that number right now if you want. Leave your name, your information, your telephone number. Ashley will give you a call back during the week to set up an appointment for you to sit down with Jake and or Randy there at Floyd Financial Group and talk about your journey towards a prosperous retirement. Once again, it's not going to cost you a dime whatsoever. Totally complimentary, and it's just a casual conversation. 417-889-7233 is the number to call to get your opportunity to talk with Jake and Randy in person. You can also request your plan online at FloydFinancialGroup.com. It's FloydFinancialGroup.com. Time for a break, Jake. When we come back, we'll be talking about the seasonality of the markets, sell in May and go away. Is that still the case? All that and more when our show continues here on 104.1 KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment we're going to be talking about should we sell in May and go away?
And Jake, I don't know the answer to that. I'm hoping that you'll tell me. Wednesday was May 1st. Should that frighten investors? Well, the old saying, sell in May and go away, is not just folklore. Stock market history does support it. So what is there in the stock market history that supports sell in May and then go away for the rest of the year?
Yeah, so let's kind of define what we're talking about here. There's an old adage on Wall Street that says that we should sell in May and go away. And then the part that's not mentioned there is that you buy back in October to November. Really like November 1st is kind of the best way to do it. And so if we look statistically at the history of the market, the 6 months of November through May, you get a 6.7% average return over that 6 months. And then the rest of the time, the other 6 months, it's 2% average. So both are up, but it's up a lot more from November through May. And so The idea is, what if we just sold in May and went away and bought back in November or end of October? There is some truth to how that works. And you also tend to dodge a lot of the, summer and September and October doldrums if you do that. It's not necessarily a great strategy, though, because depending on what year we're looking at, there are years where the market went up a lot over that period. Last year, the market went up a ton during that period. And as we're thinking about what we should do, it's important not to take any kind of blanket advice here. There's a lot of this would depend on, your goals and what the purpose of the money we're talking about and all that. But seasonality is kind of an interesting thing when it comes to the stock market. There are some assumptions that can be made and some ways to lean to get around some volatility in some cases.
I don't want to get into that, the seasonality of the stock market, but something you said that was interesting was that last year seemed to be an exception. So if you held to the old adage, sell in May and then go away until October, if it was last year and you did that, it seems to me like you would be missing some opportunities.
Last year at the 1st of November is when the market really started to run. So it wasn't that necessarily that it wasn't true, because the November through May segment did incredibly well. It was just that it also did pretty well not in that period, right? And so we don't want to just leave money on the table. The longer I'm in this business and the longer that I've managed assets, the more I realize that there is some truth to the time in the market theory, which is timing the market is not as important as time in the market. Meaning, if you're just in there and you stay in there, for the most part, it's going to be fine. Now, there are exceptions, and I do manage money actively, meaning we do move monies around and try to take advantage of certain things going on in the market. However, simply being out for years at a time is definitely not the right strategy. I talk to people all the time. They're like, hey, I was in 2008 and I got clobbered and I just decided not to invest again. And while that's, your prerogative, from the bottom in 2009 to 2020 before the pandemic, the market was up like 440% over that period. And so all you're doing by selling at the bottom is just locking in those losses. What we want to do is try to do the opposite of what maybe it feels safe to do, meaning when the market is really good and everybody's really optimistic, that's usually when you want to be selling or at least being careful. When things are on fire and we're at the depths of COVID, everybody's locked in their houses, we got a third of the workforce laid off, and the market's down 13% in one day, that's usually a great time to actually put money to work. Mm-hmm. And while that's easy to say and harder to do because there's extreme panic going on at that moment, it pays very well to do that.
It's interesting that you would say that, because I think most people, when the market's on fire, they're going, well, I've got to get into this, when in reality, it should be the opposite. When the market is down, I think it was Warren Buffett maybe who said, when blood is running in the streets, that's when you want to buy. You want to buy low and sell high. But it seems that many investors do just exactly the opposite.
Yeah, it's because that money is very emotional. You've worked your whole life to amass the money that you have. A lot of people have in the stock market, 401ks, whatever it is. And it's very emotional because that's tied to all your time investment over the years. And so that's one of the benefits of having an advisor, is having an advisor that can look past all that and say, hey, let's invest here, but let's try to take the emotion out of it and do what we should be doing. And Warren Buffett, again, I don't agree with Warren Buffett's politics. However, his investment advice and his history as an investor is incredibly hard to argue with. He's arguably maybe the greatest investor of all time. He has lots of great sayings, and I think maybe his greatest saying is you need to be in there buying when there's blood in the streets, especially when some of it's yours.
But I would think that when the market's down, Jake, there is a reason for that, why stocks are basically on sale. Is that a valid way to think about it?
Well, usually when there's a really steep discount on stocks, so like COVID or 2008, what you really have is a liquidity crisis, right? Meaning everybody's pushing the sell button and nobody's pushing the buy button. Apple stock, is what, $170 a share or something like that. I'm not personally a big fan of Apple stock here. However, if they were offering it to me at $50 a share, I'd probably load up on it, right? So at some point, everybody's a buyer, right? And so if we have everybody selling and nobody buying, then, they just keep pushing the sell button, then we're going to go down on price really fast. When that happens, eventually the liquidity crunch will go away. And so the market, by default, will have a very steep recovery at some point. The question is that going to be tomorrow or 6 months from now, or when, it's harder to do that because it's very emotional in the moment, but it's a liquidity problem. And that's why when those moments seem the most dire is the best day to get in because you have the least liquidity on those days. And so the next day, it's very likely, or certainly the next week or 2 weeks after that, that markets are going to recover quite a bit as people flood in and the hedge funders get greedy and they're like, oh man, all this stuff is way on sale. I got to buy everything. Buy. And all that buying pressure sends things back up. By and large, it pays to do the opposite of what the masses are doing.
Talking with Jake Floyd of Floyd Financial Group, we're talking about the seasonality of the stock market, and we're talking about the old saying, sell in May and go away. And I think you alluded to it, Jake, is that when the market is down, and particularly during summer months when things are a little bit slow, that could be the opportunity for you to swoop in and make some pretty good deals. But how do you know when these stocks are down in the summer that they're not going to stay down for the rest of the year? I mean, how do you know that they're going to be coming back up once October comes?
We don't really know that, right? But we can use history as a teacher. And so usually as we get closer to Christmas, people start to get excited, right? Because everybody starts buying everything, frankly. But certainly retail businesses and things like that they call it Black Friday because that's the day that they stop losing money for the year, right? They've been losing money all year, retailers, and now Black Friday is the day that they go into the black, meaning they're actually profitable. And so as you get into that, sentiment starts to shift and everybody gets excited and people are like, hey, everybody, all these businesses are doing great. We get into Christmas, and Christmas, there's lack of trading going on. That's the Santa Claus rally. It's like 93% of the time the market's up from Christmas to New Year's, and then you get into the new year, and then you have earnings reports, and they're usually better than feared. And so you have this kind of frenzy that happens. And that usually starts toward the beginning of November. Again, that does not happen 100% of the time, but it does happen the lion's share of the time. And so using seasonality is definitely, it's not the be-all, end-all, and we shouldn't trade or buy and sell things just solely based on that. But it is a factor when we're determining what moves to make and when to make them.
So, Jake, as a seasoned investor or a professional like yourself, if I'm hearing you correctly, you're not putting a lot of stock in sell in May and go away. What are you really looking at to determine whether or not a stock is a good buy for the long term?
We'll use another Warren Buffett adage here. He said, I'd rather have a good company at a great price than a great company at a good price, basically. And so what he's saying is the value, how much you pay for something matters. It's kind of like if you're going shopping for a brand new Subaru Outback, right? Now, again, I don't know exactly what these cost. My guess is, kind of a middle of the road one's probably in the $40,000 range.
Right.
And that may be great. And you may say, hey, I love the Subaru Outback. That's great. You buy it at $40,000. But you would never pay $100,000 for one. And so the stock market is kind of the same way, where it's like some of these companies are good companies, but they're just way overpriced. Or vice versa, where some of these companies are way too cheap. And I would argue that a lot of big tech, honestly, is pretty cheap here. If you look at the driver of the market over the last, really even like 30 or 40 years, toward the end of the last millennium, we had oil companies driving things a little bit, but you've always had tech driving. And certainly since 2000 and forward, tech has really driven a lot of things. So those companies not being too expensive, again, in my opinion, really shows that the market is not worn out. I think there's a lot of people trying to paint the market as worn out and that it doesn't have any more room to run. And I would just definitely disagree with that sentiment.
Jake, we've been talking about the stock market, sell in May and go away, and the seasonality of that. Does that saying apply to other investing opportunities? What I mean is the summertime, is that a better time to look for opportunities all over the place?
That's a little bit of a hard question to answer because we're talking about all kinds of assets. But basically, the reason why it applies more to the stock market than anywhere else is because everybody's on vacation, so they're not focused on their accounts. And if nobody's really doing any trading, or if trading volume comes way down, just simply people funding their 401ks and that forced buying into the market will kind of keep things going up a little bit, but it basically just kind of is going to go on vacation like the people over summer. And that lack of trading makes it so there's not a lot of movement. Things don't get too exciting usually in the summer. Now, that being said, if everybody's on vacation and things are falling apart, then people start calling their broker and say, hey, just get me out of here. I would just say that it's the idea that people are spending time with family and going on vacation that creates that seasonality to some extent. Then once people get back into school and everything, then get back in the swing of normal work and all that kind of thing, that's when it starts to normalize again. Whether it applies to housing and those types of things, I mean, I would say maybe not quite as much to housing, but more risk on trading type assets, gold, Bitcoin, also these to a lesser extent than the stock market, but it does have some weight there as well.
Talking with Jake Floyd of Floyd Financial Group, and we've been talking about the seasonality of the markets, sell in May and go away, Santa rally, that sort of thing. If you've got questions of Jake, you'd like to sit down with him and talk about your individual journey towards retirement prosperity or a confident retirement, once again, we're offering a no-cost and no-obligation opportunity to have sort of a private conversation with Jake to get the questions answered that you need. That telephone number to get yours, 417-889-7233. Again, this conversation is not going to cost you a dime, but it could be the best phone call that you'll make all year. Once again, that telephone number, 417-889-7233. Now, I know it's the weekend right now, but while you're thinking about it, before you get too busy during the week, go ahead, jot that number down or call it right now, 417-889-7233. Leave your name and telephone number. It's going to be less than a 60-second call to do that. Ashley will take that information, give you a call back during the week, and set you up with an appointment to sit down with Randy and Jake there at Floyd Financial Group and get your questions answered. Once again, no cost, no judgment. It's just a friendly conversation. 417-889-7233. You can also request your conversation online at FloydFinancialGroup.com. It's FloydFinancialGroup.com. Jake, it's time for another break. When we come back, we'll be talking about this new Social Security bill. What's that all about? All that and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment we're going to be talking about the new Social Security bill that Congress has introduced.
Jake, you're exactly right. This bill has piqued my interest as well, too. A bill has been introduced to eliminate taxes on Social Security benefits. The bill would repeal Social Security taxes. It's called You Earned It and You Keep It. What do you think about this, Jake? Does a bill like this really have any legs?
I mean, it seems fair to me.
Yeah, but, it seems fair, but...
Yeah, I mean, because I think there's a lot of people that come into my office and are like, wait a minute, I have to pay taxes on Social Security? Like, I already paid taxes on it. And so I think there's a lot of truth to that, and it's not very intuitive that you would have to be taxed on it again. That being said, I think it would be a gigantic sucking sound out of the revenue of taxes in this country, and we're already at a nearly $2 trillion deficit as far as budget to tax revenue is concerned. So I can't imagine that this would pass, although, it would be a huge tailwind for most of my clients.
Yeah, because there are about 100 million people out there in the country that would really support such a thing. But again, it's interesting to think about, but I don't think it has any legs at all, especially during this current economic situation when we're in so much debt. I don't know how a bill like this would ever be introduced when they're looking to cut tax revenue and we really just need more taxes. What's the mentality of that, do you think?
I would imagine, I didn't see who introduced the bill, but I would imagine it's probably a little bit of a vote-buying situation, right? Where they say, hey, I introduced a bill to get rid of taxes on your Social Security. You should vote for me. So that would be a very popular sentiment, I'm sure, amongst seniors and people that are currently getting Social Security or about to take Social Security. So I can see it from that angle, but I can't imagine he really thinks it's going to get passed, although Congress has done a lot of dumb things over the last however long, so I think anything's possible at this point, but unless they tie it to something else like Ukraine or something that everybody else wants, I think they're going to have a hard time with it.
Yeah, and I was looking to see the source of this, but it doesn't say who introduced this bill. It's an interesting concept, but I think that basically, read the article, there's really not much of a chance of that happening. But let's talk a little bit about Social Security. I mean, a lot of people say, well, I'm going to take it at 62 because it's going to go away. What do you think is the real possibility of Social Security ever completely going away?
I think it rounds down to zero.
Yeah.
I mean, nothing's impossible, but there's a lot of people really concerned that Social Security is going to go away. And while I understand where they're coming from, I just don't think that the government is going to allow 50 million Americans to starve to death in their houses.
No.
Not because I don't think they're that evil. That's a whole other discussion, but I think it's really because those people then don't vote for them. So at the very least, we can trust the greed of those people. I know I say that a lot on this show, but people are greedy, and companies are greedy, politicians are greedy. So I think the fact that it would go totally away, I don't think so. I think it's going to get reworked over the next few years. about the same time as a lot of people really start to retire. A lot of the end of the boomers get retired. I think that taxes are going to have to get reworked as well. 2026, the Trump tax cuts expire. And as all that happens, I think there's going to be a lot of talk about all these things. And what we'll likely see is just a revamping of Social Security. They may even call it something else, but I don't think it's going to just go away.
Yeah, I think they should call it social insecurity. And we're going to talk about that here in just a moment. But for boomers, I mean, people who are taking Social Security now, do you think in our lifetimes that we'll really see any difference in what we're getting, or do you think that we'll be grandfathered in?
You know, that's usually the way the government likes to operate in Congress. They don't want to have to deal with all the red tape, so they'll just say, hey, it's May, so if you filed before January 2024, you get grandfathered in. So that they can't create this feeding frenzy. Because if they do it in the future, everybody and their brother is just going to go file Social Security, which exacerbates the problem, right?
Yeah.
It'll be kind of a retroactive grandfathering in my opinion. Again, that's total speculation at this point, but that's usually the way Congress likes to operate because they don't want to have to deal with all the math and mess with, they make it very easy, very clear, and make it easy on themselves, frankly. And then, looking forward, there might be some kind of a cut. And that's been proposed by a couple of different people. Social Security is definitely going to get cut in some form or fashion, but I think it's more likely what will happen is people like me will have to be 90 to get it.
Sorry about that,
whatever
Jake.
the number is.
So with that in mind, I mean, how are you planning for Social Security? Are you planning for it to be there at all when you get to be so-called retirement age?
I think if you're 20 to 40 years old, I would be careful on what you plan on for Social Security. I think if you're 55 or older, I think Social Security will be there for you. I don't think it's going to be a big issue. I do think, though, it's also likely that they will increase tax revenue around Social Security. So right now, if you make more than like $180,000 a year, you stop paying Social Security tax above that on a W-2 wage.
Mm-hmm.
So just imagine if they just opened it up to where, if you make $1 billion, you still pay Social Security tax. That would fill it in pretty quickly. Again, I don't think that that's fair, personally, to have one person fund 100,000 people's Social Security, but I do think that that's an easy way for them to fix it. And, a lot of the liberal billionaires out there are begging them to tax them, so I guess they may oblige them.
Earlier, I mentioned the phrase social insecurity. I want to expand on that a little bit, Jake. The average Social Security check, when you add it up over an annual basis, comes to a little over $22,000 a year. Now, there was a time in my parents' generation and your grandparents' generation when you could live on Social Security benefits alone. Not the case anymore. Do you find that Social Security, when you're planning for retirement, do you find that it should be maybe comprising of about maybe 40% of your income?
Yeah, I think that's where a lot of people have it, where, Social Security is maybe 40 to maybe 60%, depending on what you did for a living, depending on how much you need a month to live on, all that kind of thing. But yeah, it's definitely not usually the only source of income. Other people have maybe some pensions. Pensions are kind of few and far between these days, but everybody else is going to be relying somewhat on their investments or 401k, retirement plans, that kind of thing. And so it would be pretty devastating, though, to most people to lose Social Security or to even to have it cut. So that's something that I spend a lot of time talking about in the office here. We don't really know what way it's going, but we try to hedge against that in any way we can.
And Jake, I was always under the misconception that Social Security was a static amount. I mean, this is what you get over your lifetime. It can be no different from that. But can you really affect the amount of Social Security that you're going to get with proper financial planning?
So, Jeff, there's a lot of softwares out there and Social Security maximization software and all that. I can promise you all the numbers will look the best if you delay Social Security to 70 and you never retire and you live to be 110. But that's not realistic for most people. When it comes to Social Security, I'm a little bit of the odd man out as far as a lot of people, a lot of other financial advisors would be concerned. And I think a bird in the hand's worth two in the bush when it comes to Social Security. So once you retire, I think there's very few reasons to wait. If you're fully retired and you're not planning to go back to work. Obviously, we don't want to turn on Social Security when we're working full-time because we'll end up having to pay Social Security back, and that doesn't make sense. But let's say you retire at 64. Sometimes people come in and say, well, I need to wait till I'm 67 or 70, and so I just need to spend my money until then. And I would disagree with that statement, both because of the reason we talked about with Social Security potentially getting grandfathered if it changes, but also I would rather you retain money in your control in your accounts and lean on Social Security earlier to make that possible, rather than spending all your money and leaving all the control in the hands of Social Security, especially knowing that it's going to be broke before too long and they're going to have to figure out ways to cut spending. So again, I'm a little bit of an oddball there because most of the CFPs and all these other people, are like, hey, you need to wait till 70. Well, not everybody can afford to wait till 70.
Right.
We don't know what tomorrow will bring. We don't know if you're going to make it to 70, frankly. Things happen to people. You drive home and have a wreck and you never got any Social Security. So I think having a strategy that maximizes, with air quotes, Social Security is very important. But your definition of maximization of Social Security might differ from mine.
Jake, if someone somehow knows that they're going to make it to 85 years of age, they really believe that they're going to make it to 85, and they're thinking of taking Social Security, do they actually get more in Social Security if they wait until 70 as opposed to taking it at 62? Because at 62, you have 8 more years of Social Security. Are you really going to make more if you wait until 70 in the long term?
So it depends a little bit on how you calculate it. If you're going to live to 85 and you measure taking it at 62 versus 70, if you figure a 0% rate of return on the 8 years of payments that you would otherwise have taken, then at about 82 years old, you would break even. However, if you had even like a 4% interest rate on that money the whole time you've had it during that 8-year period and then the next 15 years after that, I think the break-even number is more like 94 or something like that. So I really think that Social Security is a tool to be used to maximize your control over your destiny. And it's not always about getting the maximum amount of Social Security possible. Sometimes it's getting it sooner rather than later so you don't have to spend your assets down.
Yeah, and if you take it at 62, I mean, as you said, you're going to get less in benefits, but, what are you going to do between 62 and 70 if you have no other income? So, again, Social Security, it's a very individual calculation. If you've got questions about Social Security, when to take it for you is the best time. You want to sit down with somebody who has been down this path before who can help you answer that question. Once again, we invite you to get in and sit down with Jake and Randy at Floyd Financial Group. Ask your questions about Social Security and all the other factors in your journey towards a confident retirement. Once again, we're offering a no-cost, no-obligation, and no-judgment retirement review with Randy and Jake at Floyd Financial Group. To get yours, call 417-889-7233. 417-889-7233. Pick up the phone this weekend. Pull over if you're listening in the car right now and make that call. 417-889-7233. Leave your name, your telephone number. Ashley will call you back during the week and set you up with a conversation to come into Floyd Financial Group and get your questions answered. Again, no cost, no obligation, and certainly there is no judgment whatsoever. So take advantage of this opportunity. 417-889-7233. You can also request your plan online at FloydFinancialGroup.com. It's FloydFinancialGroup.com. Jake, we're going to take a break. When we come back, we'll be talking about 10 eye-opening retirement statistics that should prompt you into action. All that and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpa, Jake Floyd.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this last segment we're going to be talking about 10 statistics that are eye-watering, eye-popping, eye-something, but they're kind of alarming.
These are actual statistics taken by a real person. I don't know the source of these necessarily, but our producer does a great job here, and I know that all of these have been vetted. So let's dive into the first stat here. Jake, I want you to comment on these. And I understand there's a large percentage of Americans today who have absolutely no savings whatsoever. I mean, they're not only living week to week, they're living day to day, hour to hour sometimes.
Yeah, it's hard to believe that most people have struggles with trying to come up with an emergency fund, but 33% of Americans having no savings at all, that is a pretty eye-watering statistic.
And Jake, why do you think that almost a third of people have no savings? Is it a lack of discipline? Is it a lack of just having common math sense? What do you think it is?
I think it's a little bit of a combination of those things, but I think the main thing is people are interested in themselves, and they're interested in what they want and when they want it, which is right now. And I think people are used to, we have convenience more than we ever have before. I remember when DoorDash was starting to become a big thing toward the end of COVID and that kind of thing. But there's a lot of people that are 16 years old living in their parents' house, ordering Taco Bell DoorDash at $20 a pop.
That's right.
and I think there's a lot of the payday loan mentality where, like, why would I wait a week to get my pay when I can just get it now at 27% interest?
Yeah.
And I think people think it's a mystery why they don't have any money. And everybody has things that they spend money on, but at the same time, you need to understand the consequences of those actions. I think financial literacy is part of the problem. I think a lot of people. We've talked about this before, if you went and got a 99-cent coffee and with tax it came out to $1.07, and I went to the drive-thru at McDonald's or wherever, and I say, hey, here's $5.07. Give me my change. And they kind of look at you like you have three heads.
Right.
And that's crazy. I mean, when I was in second grade, they had actual money in the classroom.
Yeah.
And they're in there, they're practicing this kind of thing. Like, okay, so if I gave you this, how much would you give me back? And it's relatively basic math, but the standard of education in this country has gone totally through the floor, especially in more liberal urban areas. But even around here, there's places that you go in and basic math is just nowhere to be found.
33% of Americans have no savings whatsoever, and we really don't know the definitive reason why, but it could be this immediate gratification society that we're in right now. Next stat's rather interesting. It's about Social Security payments and how much people are getting on an annual basis.
Social Security payments are, on average, less than $22,000 per year.
Wow.
So there's a lot of people that are going to be relying on that in retirement to make ends meet, and I think they're going to be shocked by that at some point because that's not a ton of money in today's world. In Biden's America, $22,000 doesn't go very far.
So unlike our parents, grandparents who relied on Social Security, you really have to consider the Social Security. It's really just a supplement to your retirement, and you're going to have to do something else. $22,000 a year, less than that, because the average check, Jake, is around $1,770 a month. That is just not going to make it. The next one, Jake, is the percentage of Americans who are actually investing. What is that?
Yeah, so the latest statistic is that 61% of Americans are investing in the stock market. And I think what's kind of interesting about this stat is the number here was about 6% prior to ERISA and the advent of the 401k in the late 70s and early 80s. Only 6% of people were in the market. Now it's 61, which is obviously a whole lot more, but there is a reason why certain people are not participating in the prosperity of the last, 20 years or so, and it's because they're not invested. And while inflation is up a lot, if you have been invested over that period, your money is also up a lot. It's up a lot more than inflation. And so, there's a lot of people whining and crying that, well, I don't have any money in the stock market, so I'm not benefiting from this, and I need handouts. And I say, well, that's on you. Everybody can make better decisions. If you have wages, you can invest money, period. You may not like it, and you may not like going without your triple shot, half calf, vanilla soy latte thing.
Right.
But ultimately, that's your decision. And that's okay. There's nothing wrong with that decision. I just don't want to hear people whining about it.
We're talking about 10 eye-opening retirement statistics that should prompt you into action with Jake Floyd of Floyd Financial Group. The next one, Jake, is the percentage of people who are in debt or either struggling or in crisis with their money. What is that?
I think a lot of this, too, I don't know what the statistic was, 10 years ago, but I think that some of this we're seeing is inflation, right? Where people used to have enough money, and so they didn't worry too much about their day-to-day credit card debt and things like that, and they'd pay it off from time to time. I think it's also a reflection of not being able to use your house as a piggy bank anymore, meaning you run up the credit card debt, and then you just go refinance your house to pay it off, and that's been the case for 20-plus years. And this is the first time in a long time that you can't really do that because interest rates are too high. I think those are probably the reasons for that more than anything.
45% of people are struggling with debt, and when you borrow money, I've always thought of it this way: the borrower is slave to the lender, so don't be one of those people. The next one is the number of American workers who are living paycheck to paycheck. This is a rather large stat.
Yeah, 78% of American workers are living paycheck to paycheck. I would say that that's true, number one. I think that includes some very high earners, right? The people that are making $250,000 a year driving a Porsche, without $15 to put in the gas tank.
Yeah.
And I do see that from time to time. People come in and they're like, yeah, I'm making great money and I've got, $50,000 saved. And I'm like, okay, and they're 55 or whatever. Sometimes, I get to be the reality check and go, okay, so if you're not saving money now, when are you going to save it? You're making this great income, and that's awesome, but you do have to. You can spend any amount of money, Jeff. I can promise you.
Oh, yeah.
It doesn't matter how much money you make. You can save money or spend it all at any level, and I think that's important, because a lot of people say, well, it's my circumstance that keeps me from investing. That's not true. It's just you're not willing to do what it takes to get that money invested, and you're not willing to sacrifice what needs to be sacrificed. And for some people, they have more to sacrifice than others, but it's still the same thing.
Yeah, and that was an interesting stat. As you said, there are many people making over $100,000, many over $200,000 who are living paycheck to paycheck because of their circumstance. But the circumstance has four wheels, and it's in the garage, and it has a 911 on the back of it, too. Let's talk about the percentage of Americans who have a hard time paying rent or the mortgage. That is pretty high.
64% of Americans have a hard time paying rent.
Wow.
And yeah, I mean, that's a big number. I think people think that this is, at least people on the left think that this is fixable by doling out money to everybody. I think that this is a mentality problem and a discipline problem and a financial literacy problem more than it is a circumstance problem. And I think that until the mentality changes and until we can figure out a way also to educate kids in a way where they can understand some of this stuff before they're 35, I think that this is going to continue to be the case. And no amount of giving money to broke people is going to fix this, because they will simply just spend it the way they did the rest of their money. And so I don't know what the solution is, other than just to try to get education back into education institutions. But short of that, I don't know what the solution is. But it is a staggering statistic that 64% of people have a hard time making their rent payment every month.
And I will handle the next one in the interest of time, Jake, and that is Americans are over $1 trillion in credit card debt, and those credit card interest rates are between 28 and 30%, so consider that. That is amazing. What is the percentage of non-retired people that feel on track with their retirement savings, do you think, or at least according to this stat?
So I think it says only 31% of people, non-retired people, feel on track with their retirement savings. I think that's probably, though, more people than probably should, based on what I see. Although a lot of people in this area that come to see me are in very good shape, there are a lot of people that are not, and that are a little bit over-romanticizing their situation. So, but again, we don't do a very good job in this country educating people on what they need to retire. If you were to ask 100 random people what they need to retire, most of them would way underguess the number.
And Jake, the next one is interesting. It is the percentage of workers that haven't calculated what they need to live on in retirement. People are working, they're figuring out how much they need to retire, and a large percentage of those people just don't know what it is. What is that percentage?
Yeah, so 54% of people haven't calculated what they need to live in retirement. That's a big portion of what we do here, is try to work on the B word, the budget, right? And a lot of people that have made good money and saved good money haven't really had to budget, because they've always had more than they needed. But as you get to retirement, you do need to understand how much outgo you have, so that you can understand how much income you need to have, so you can arrive at the destination of retirement.
And Jake, our last one here is rather alarming, and that is the percentage of people who have no one that they can turn to for retirement advice. What is that?
Yeah, so 40% of people have no one they can turn to for retirement advice. I would argue that number is probably a lot higher than that if we put the word good retirement advice in there, because there's a lot of people that think they're experts and really don't know what they're talking about. However, I would say that this is the primary reason I'm here doing what I do.
Right.
Is I try to be available for people. And you don't have to have millions of dollars to come in here and see me. I want to help people out. I want to be able to bring value to people's situation. If I can't bring value to people's situation, I will not try to interject myself, right? But I've had the privilege of helping, hundreds and hundreds and hundreds of people retire over the last 17 years. And so I just get to see it more. It's not so much that I'm just smarter than everybody else. It's just that I've seen it so many times. and you're only going to retire once, hopefully, right? And so I can help maybe avoid the potholes of retirement for you.
Well, if you're one of those people who feel that I have no one to turn to for retirement advice, I've got some good news for you. You have found someone, as Jake said, who is honored and proud to be able to do that for the fine people here of Springfield, Missouri, and the people here who are listening to our radio program. It's called Floyd Financial Group and Jake and Randy Floyd. If you would like to get some answers to the questions that you need to put you on a path towards a confident retirement, and no question is off limits whatsoever, call this number and do it today, 417-889-7233. It is just a very simple call. It'll take you about 60 seconds to leave your name and telephone number, and Ashley will give you a call back during the week and set you up with an appointment with Jake or Randy at Floyd Financial Group to get those questions answered. We're here to support you and to help you along like a Sherpa in your retirement journey. Once again, make that call this weekend. 417-889-7233. Request your no-cost, no obligation, no judgment retirement review. You can also do it online at FloydFinancialGroup.com. It's FloydFinancialGroup.com. Jake, we're out of time for this week. I want to thank you for your time, but most importantly, I want to thank our fine listeners for joining us here at the last bastion of sanity, Springfield, Missouri. For Jake Floyd, I'm Jeff Shade. Have a great May weekend. We'll talk to you again next week with another edition of Show Me the Money right here on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and are not intended as investment advice for any individual or entity. All information contained herein believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning offered through Floyd Financial Group, LLC, an investment advisor registered in the state of Missouri.